Good morning, my name is Prince of Kieci. I'm Chief Economist of XTB, and it's my pleasure to be with you during this weekly trading webinar presented by XTB. So let's move on to the presentation. Today I prepared 10 charts that you need to know to be in a control of the market situation. But before we start with these charts, let's start with the top news of the week. The news that you need to know on Monday morning. So the biggest news actually is something that is not really the news anymore, but that certainly has had the impact on the markets, and that's 1,400 checks that start being paid out in the US. And last week, when you saw the market action, it was pretty much drove by the expectations that these checks are going to soon arrive at the US households, and therefore at least partly they will be spent on stocks, and therefore if you know that someone is going to buy stocks in the future, why not buy it now? So that drove indices to new record highs for most of indices, and that helped also a strong rebound on the US 100 despite US bond yields rising even more and now beyond 1.6%. Strong economic data from China today. However, bear in mind that these massive increases that we see in the calendar, 30-something for output and sales and investments, are driven by the fact that last year in February we had a lockdown in China because obviously of the pandemic, and therefore comparing this past February to February of 2020, obviously you had a massive jump in activity, even though even with this in mind, this data is strong, and therefore Chinese authorities are restricting policy, and you may see actually markets not doing so well in China these days. So we have this paradox continued, whereas weak or mediocre data, it's great for markets because that allows central bankers to keep them printing money and to keep loosening conditions, and investors like it, and greater activity, better economic performance is not so much welcomed by the market, because it means that authorities will need to tighten the policy and prepare for more of this this year. Very rich calendar this week, with certainly the top event of the week being FOMC. We'll discuss this in a minute. US sales on Tuesday, Bank of England, Bank of Japan meetings as well. Some bad news for Merkel's party in Germany, where Greens are taking advantage of government struggle against the COVID, and other than China, relatively calm opening of the Monday trading, with indices slightly down, oil and US dollar slightly up. Okay, now continuing with a quick recap of a previous week. Last week we discussed this possible overbalance pattern on US 100, and it worked very well. As I said, not only technicals but also this urgency to be in front of all of those checks was a driving force, and indeed you saw two strong green candles here. So obviously with US 100, it's still a bit uncertain if this is already a return to trend, or was it just a rebound from the support and a continuation of the downward movement. Because if you look at the markets in a broader sense, we see this possible double top pattern on S&P 500. Obviously it's still very early. This market has been very consistent, so you need to be careful with betting against it, but at least technically it is possible that we might have a double top here. So a double top S&P 500 would obviously not be a very good development for US 100, whereas here it's a bit mixed, right? We had strong rebound, but right now markets are struggling. But bear in mind, still early in the morning, so US investors are obviously still not here. So a lot will be clarified today at the opening in the US session. So a lot is possible, but yeah, bear in mind this S&P 500 situation, because on one hand this pattern is interesting for the bears, but then again obviously there might be a lot of stops above here. And just keep in mind what happened in Germany. We had this resistance slightly below 14k 200, and it kept the market in check for a long time. But then when eventually the index blow this up, so and the prices went much higher, so obviously those betting against it were in trouble last week. All right, let's move on. And yeah, we talked about the DAX, so a quick recap of the ECB decision last week. What we said last week was that ECB is unable to really impact the economy anymore, because they are in the dark corner really, with negative interest rate, with such a massive QE, with all these LTROs, TLTROs, and as you might see, it doesn't really produce long-term healthy economic growth. So what the ECB is doing right now, it enables governments in Europe to borrow on the cheap, because otherwise everything would collapse. And why it might not collapse, I'll show you on the last chart from the topic of the week. So they are really prisoners of their own policy, and they need to continue this narrative. So what they did, they said, look, we will react to those rising bond yields, and we might increase a pace of bond purchases. But they didn't say to really what extent. They actually said that this range of buying will be pretty broad. So the lower point of this range is actually below of what they were doing, but this higher point is above of what they were doing. So we'll really see what they're about to do. Their impact on the market was really minimal. The bonds which you see here, they reacted positively instantly, but then actually a large chunk of it fades out, and not a lasting impact of this meeting. All right, so let's move on to this story of the week and top 10 charts to watch. So we start from a very general chart, you'd say, very long-term chart that obviously doesn't have near-term implications, or not necessarily, at least, where you can see there's a relationship between MSCI world to the world economy, and as you might see, it's way above what we had at the peak of the dot-com bubble. So obviously this is something that you have to have in the back of your head. I know it will be easier to forget it, but with stocks beating records day after day, and depending on your outlook, depending on your horizon of your portfolio, you have to have it in the back of your head, because obviously, if you think, well, this bull market may very well continue for five more years, then the question is, what's room here, whereas it's so much above historical peaks. And interestingly, if you look at this chart, you might notice that even 1 year ago, actually it's the lows of the pandemic market were roughly a year ago, they were still above 25-year average. So this market wasn't really that much cheap last year. It looks cheap from today's perspective, obviously, because today everything is so expensive, but from long run perspective, the cheap market was in the GFC, where it dropped below to 2 standard deviation of the average, not a year ago. So continuing, obviously nothing happens without a reason, and a big reason why stocks are so expensive today is central banks that are printing so much money. And with this ECB acceleration of bond purchases next month will probably mean even higher influx of new money. Not necessarily it's a net liquidity increase, because remember, this huge government deficit, they need to be financed somewhere. And last year, actually, the Treasury in the US was able to build a cushion of liquidity, because the Fed printed so much money that actually even with the huge deficit in the US, the government was able to build a cash position. This year with the QE, without this spike, it's no longer going to be the case. We discussed this, I think, last week or two weeks ago. All right, further on, because of this is possible. This is a relationship between major assets like bonds, gold, indices to the US economy. And if you think from a logical point of view, this should be more or less stationary. That means that it should obviously there's always some volatility, but it should move around some flat average, right, in the long run, obviously. But what you can see here, it's not only it's rising, but it's rising in hyperbolic terms, and this happens because because of the central bank policy. So and interestingly, as you can see, obviously all these ratios, like here, stocks to the GDP, they're already above what we had at the top of the dot-com bubble. But here it's even more pronounced because you have more of tech here, and you have also bonds. Back in 2000, bonds and gold were much cheaper than today, because obviously you had higher interest rates. So even though the tech stocks were very hot, they were the other half of this index was much lower, and today everything is expensive from a historical perspective. All right, moving on, inflation, and we are really moving to the inflection point of this presentation. And inflation is obviously something that we discussed many times over the course of the past few weeks or few months even, and we said that this is really going to be a key driver for markets this year. However, many people accustom inflation to commodity prices like here, whereas what's important is if companies are able to carry over their higher costs, which are clearly higher, to consumers. This will play out this spring, and it will really have massive consequences for the markets, because here it's you can see historical core inflation for the US. And as you can see, we are around this point here. Inflation is still fairly low, but it's been low. It was low in February because of high base of last year, but now this base will change very dramatically. So inflation, regardless of scenario that you have, is going to pick up. It's going to be above 2% very soon. But what's important is what happens next, because if a situation from the beginning of two previous cycles, where the inflation at the beginning of the cycle was very low, and the Fed really hopes that it's going to be that like this this time around as well, it picks up, but then it moves down and stays at, let's say, 1.6, 1.7%, and then the Fed will tell you, look, it's returned to low levels. We need to print more because we want it above 2%, even though they don't want it above 2% because it's really scary for them, but they say it in order to justify their policies. Whereas if inflation this time around, if companies are able to transfer the higher cost to consumers because of balance sheets, because of their openings, because of really high dynamics in commodities, and if we take the average inflation between 2005 and mid 2008, we are going to stay, at least in the US, is going to stay with inflation above 2.5% after this base effects play out. So this will obviously have very strong ramifications for markets, because obviously if inflation is this low, then these bond yields that we have today are already too high, and the Fed will be able to push them down with even more QE. Whereas if it's like this, then these yields are very low. So obviously it will have massive consequences, and we already can see this in China, where, like we said, the data the data continues to be really solid, and the policy is that they react to it, and markets do not like it. So like I said, this paradox continues, where weak data means more QE and markets are happy, and stronger data, actually, at least in China, it means more restrictive policies, and the indices are in trouble already. Okay, so moving on with this, pay attention to junk bonds in the US, because obviously junk bonds are issued by weaker companies, and last year they rallied really hard because the Fed started to buy them. They said, well, the crisis is so big, we need to do it. But right now, obviously, this is no longer the case, and if higher interest rates are more dangerous for weaker companies. So this is already something that you might watch. And as you can see, we already have some kind of divergence between S&P 500 and ETFs for junk bonds like junk US or high yield HYG US ETFs. You can compare this in Xstation platform, and you can already see that there's divergence between these otherwise strongly correlated markets. So we said about this potential double top on the S&P 500, and obviously this divergence is helping this case. So this is certainly something to watch. But for now, the market's been happy. We had this GameStop mania return, and at one point of last week, it constituted for about 30% of the Russell 2000 turnover. So we are at a very interesting point, where on one hand the music still plays like in the Titanic, and the many people are happy, do not see the issues, whereas the issue is here, because if it happens, if this higher inflation scenario plays out, then obviously all these bubble like scenarios are going to end very badly, because this liquidity that causes these scenarios, that is behind all of these scenarios, is going to eventually have to be withdrawn, and obviously all this music is going to stop. And finally, like I said during our talk about the ECB, this chart explains why the ECB cannot, why the Eurozone cannot dismantle, and like I said, why the ECB is a prisoner of its own policy. As you can see here, these are claims of Bundesbank and other central banks in the system, and they are already so massive, because Germans, obviously, they have more savings than countries in the southern part of the Eurozone, and with the QE being more or less evenly distributed across the zone, these claims are on the rise. So if the Eurozone was about to stop today, all these claims would need to be settled, and that would mean probably defaults of Italy, Spain, Portugal. So obviously, on one hand, you might say, well, this is good news, because it means that they need to stick together. But then again, obviously, for German savers, this is not very good news, because their savings are being kind of transferred, and they are taxed by these negative interest rates on their savings. All right, let's move on to this week. We are going to have FOMC meeting, which is going to be very important for many markets. We already discussed indices, but let's take a look at gold, which rebounded last week from the strong support. However, this rebound has been very weak, and therefore I'll be very cautious about gold in the near term, because it's very well settled in this downward trend right now, and bond yields continue to be a problem. As you can see, there is strong correlation, and the move on yields was still stronger than what we saw on gold. And as you can see here, a rebound from a previous support was much stronger, and therefore at least there was a major upwards correction. Whereas here, this last time around, it was just 2 days, and now it was 2 days as well. So yeah, like I said, very cautious here, because it may play out that unless the Fed really impresses markets, then this downward trend may simply continue. The same thing about the euro dollar, where this support from this overbalanced structure and the ABC correction worked perfectly last week, which we discussed last Monday. However, again, yeah, already bulls are in trouble, and if we see deterioration on indices which remain hot but with this double top possibility, then obviously this is another factor in favor of the US dollar here. So yeah, so especially gold and euro dollar, they need some kind of miracle from the Fed. If they get it, I'm not really sure, because what would need to happen, in a statement, well, the decision, obviously the policy is not going to change, let's be clear about it. What may change are those small signals that the Fed sends to the market, and obviously they will be saying that they don't like this rise in yields, that this is unwanted tightening and things like this. But the question is, what can they do about it? And the real thing would be suggesting that they could consider yield curve control. Yield curve control is a policy that, instead of saying, look, we were going to buy 100 billion of US treasuries this month, or each month into the future, we are going to buy as much as needed in order to keep the yield of, let's say, 10-year bond at certain level. However, like we said, with this inflation scenario still very uncertain, they would be potentially in big trouble if they hinted at the yield curve control this week and then the inflation accelerates. So my judgment is that they will be cautious with this. Powell will be probably asked about this policy during his conference, but yeah, well, with the Fed, everything is possible. We know what the main message is, to pump markets higher, but this is still a hard thing for them to do. So unless they support markets with some of suggestion that this could be in play, bond yields may continue inch upwards, and that will be problematic for euro dollar and gold, and obviously for indices as well. Other than the Fed, we have US retail sales on Tuesday, which will not be as strong as last month, because in January consumers had these $600 checks. In February there was bad weather, and this will be data for February, and these big Biden checks will only be seen in data for March and April. So yeah, this might not be as huge as last month. And finally, we're going to have Bank of England and Bank of Japan decisions also this week. However, both banks are expected to stay put, so probably not such big market movers. All right, so ladies and gents, thank you for your attention. I wish you a pleasant day. I wish you a successful week in your investments, and we see each other next Monday at 7:30 a.m. Bye.